Welcome to the Midsummer Canadian Economic Update, and welcome back to Building Wealth on the Go. I'm your host, Brad Wilson, Portfolio Manager with Q Wealth Partners, Wealth Advisor at KLT Wealth Management. Today, we are back with our summer episode here in August. Believe it or not, this year is rolling right along. I hope everyone is enjoying their summer so far, and we've got lots of news to update, lots of headline key indicators to go over as we make our way through this year and seeing where we stand. As a country, there's lots going on from our last update in the spring, what's happened since then, and really dive into some of those numbers and see what's going on. So first, before we kind of dive into those indicators, do want to mention last time we chatted, we discussed a lot about the negative GDP growth, potential technical recession, those indicators linking towards that, but a lot of people coming out and saying we're not in a recession. The economy is much better than that. And I think what today's update is going to prove is that was true. A lot of those forecasts, the comments from the Prime Minister, from a lot of analysts and economists is that rang true with a lot of the updates and the figures that we've gotten today. So let's get in right to the numbers. So first big number, which just came out a few days ago, actually, was the jobs beat in July, which was kind of a bit of a blowout. It was about 16,500 jobs above expected were added, almost just over 75,000 jobs added in July. And again, majority of those actually were private sector jobs. There has been the talks of the government wanting to cut down and lean out its workforce. So the public sector, is not gaining as much, but in the private sector, quite a staggering job increase there and jobs number, which is fantastic to see. And that's actually pushed our next indicator there, which is the unemployment rate to its lowest since 2024. So in 2 years, July 2024 was 6.5%. We're now at 6.4%. So that's great to see. A 2-year low on the unemployment rate does show a lot of strength in that area, that the economy is being resilient to everything going on, and that the private sector is adding a lot of jobs means that business and investment within those companies and here in Canada are going really well. And then GDP growth, a big one there. This is an estimated number based off of some of the month-over-month numbers that we've gotten so far. So we don't have a full rounded Q2 estimate, but they're projecting it to be about 3.4%, which is a really sharp rebound from that that little stall in that sort of negative growth that we were looking at in Q1 and some of last year. So we have seen the month-over-month numbers coming through and they look strong. So we're just waiting for the final reports before we get a full Q2 update. But those numbers look strong, and StatsCan's and Bank of Canada preliminary estimate is 3.4% there, which is really strong. Another thing to look at, which is good to see, is the CPI headline inflation, which from Stats Canada is reporting in at 2.8%, which is down from 3.2% in May. And that is really good to see because obviously with inflation pushing up, that puts pressure on the Bank of Canada to do something to help reduce inflation, which generally is a increase in interest rates on that front. So that is one of the things that we're watching. A big factor into that, obviously, oil prices. We talked about that with the war in Iran. Gas prices, we have seen those fluctuate. They are lower from their highs, and we have seen that kind of been still volatile over the last little bit, but it is good to see that that is trending in the right direction as well. The next is the Bank of Canada policy rate. Like I mentioned, that's what the Bank of Canada has for leverage, and what it's the main tool it has to help when it comes to economic policy to affect change throughout the economy. And for the 6th straight meeting, the Bank of Canada did hold its policy rate at 2.25%. A lot of analysts believe that rate will likely stay unchanged for the remainder of 2026, with a lot of banks and economists predicting some rate hikes to begin in 2027. So again, those are tough to predict given how volatile things are. We still have the wars going on, the war in Iran, affecting oil and, that supply chain trickle down effect of shipping and goods and whatnot. That'll continue as that remains, a major volatile piece that is unresolved. And the other thing is the tariffs and the trade wars. We did see more tariff threats come on. We'll see if that goes into effect later this month, and what sort of retaliation or counter tariff measures Canada puts in place to offset that. So lots to kind of monitor and look at. And the Bank of Canada is going to remain cautious, I think, with any decision as we continue to see things play out this year. The US dollar, Canadian dollar exchange, it's something we've talked about over the last little bit. Still at a relatively high number, 1.4 on the exchange rate. It did jump about half a cent with the jobs beat end of last week, but it is still a relatively high exchange. The dollar is weak relative to the US dollar. The other factor to look at is wage growth. And this is where a lot of people say that the jobs report is great. That's one thing that's fantastic, but we have seen wage kind of stalling, lower wage growth, which also doesn't signal that the economy is as strong as those jobs numbers necessarily present themselves in the unemployment rate. People aren't making as much money. The raises aren't as prevalent as they have been. So it is cooling, which is, not fully accelerating the economy, which is kind of, a balancing mechanism there. But the economy isn't as red hot as the other jobs numbers would report, given the wage growth. So it is important to look at all the different pieces there when we are assessing where the Canadian economy stands. So there's a kind of summary of a lot of the key indicators there. Overall, much more positive news from the economic data and indicators there that we're looking at for the Canadian economy. And as we head into, the fall and into the winter, there's going to be lots of eyes on the trade negotiations and tariffs. As I mentioned, we are looking ahead to a deadline in about a week and a half from when I'm recording this podcast. It's likely past or around the time that this podcast gets released. But those are things to be watching. Will those be delayed? Will they be reduced? Will they not go into effect at all? Will they be full in effect? And what does Canada do in retaliation to that or as counter tariff measures? So lots of ongoing monitoring. Bank of Canada will continue to evaluate all of that along with this data. We should get more inflation and GDP data as well, which will help to kind of, or as we enter close out Q3 and enter Q4 in the fall here. So that wraps up today's podcast. I hope it was informative, giving you a little bit of an update on where things stand here in Canada. Hope everyone has a fantastic end of the summer. And we'll be back in September with an episode deep diving into a financial literacy topic, diving deeper into something there.